sweeps the high, it's likely aiming for the range low next. But just watching this on the daily chart isn't enough. It shows opens and closes but not the detailed market structure needed to justify a trade. That's why we use the higher time frame to define the candle's range and drop to a lower time frame to study the market structure and confirm a tradable setup. This process is called time frame alignment and is a standard part of all smart money concept setups. If you're new, these are the most effective time frame pairings. For instance, if analyzing a monthly candle, you'd check the daily chart to find the structure that might offer a trade setup. Similarly, for a 4-hour candle, you'd use the 15-minute chart to locate potential entries. Step 4 is about entry zones. You want to focus on the ideal premium and discount areas within the candle range. As mentioned, each candle acts as its own mini-range when viewed on lower time frames. So we approach a CRT range the same way we trade any range. For example, if we define a range from a bullish candle, we're generally looking for a short opportunity. That means our entries should ideally be in the premium area, above the 50% mid-level of the range. The premium zone is simply the upper half of the range, above the midpoint. The lower half of the range, below the midpoint, is the discount area. Keeping that in mind, when we check the next 2 daily candles on this time frame, this fair value gap provides a prime short entry, meeting all structure criteria and falling inside the premium area. Conversely, if the range comes from a bearish candle, we'd seek a long entry, focusing on bullish setups in the discount zone, below the midpoint. This ensures we capture the best risk-to-reward ratio for the trade. Step 5 explains when CRT is effective and when it might not be. Candle range theory is powerful, but only works reliably in the right context. For instance, here's a bullish candle followed by another candle that sweeps liquidity at the range high. Just from this, it might look like the third candle will drop toward the range low. But even though it seems promising initially, most traders forget to check whether it aligns with the broader market structure. Looking at the larger range these candles come from, we can see this CRT setup would likely fail because price would need to overcome a strong bullish fair value gap overlapping a bullish order block to reach the range low. After this deeper analysis, our bias should lean bullish, which goes against this CRT setup. As expected, the setup fails, thanks to strong buying pressure in the bullish PD arrays. Now, here's another candle that looks like a CRT candidate. This time, it has real potential because it occurs at a key point during a liquidity attack. CRT essentially works as a tool to identify potential reversals in price direction. That's why it's especially useful during a liquidity attack, to help determine if price is making a sweep or a run.